Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, bringing you another subscriber request 2-minute drill lessons in valuation video. Today I was asked to take a look at Mattel, and it's kind of a very interesting stock to look at because they've gone through all kinds of stuff over the last couple of decades. And you see that clearly revealed when we look at FastGraphs. So let's go right in and look at Mattel, the toy company. Now, first of all, you can see that there was a time where the company paid a pretty substantial dividend. They cut that dividend in 2017 as a result of, I guess, 5 years here of dropping earnings, ultimately leading to 3 years of losses. But then they had a very strong rally in 2020 as far as the earnings went, but they're still not paying a dividend. The company currently is trading at a 10 PE with almost a 10% earnings yield, which I like. It isn't considered investment grade by Standard & Poor's with a BBB rating, and it's got about 55% rounded debt to capital. So let's see how the market price has reacted to this crazy stuff. It used to pay a dividend, no longer does. And again, you see that instantly by looking at the fast graph. When the company was doing well, the market was not afraid to put very high valuations on it at time. So the normal PE has been 16. The fair value PE is in this time frame is calculated at 12. So the orange line's a 12.48 PE, the blue line's a 16 PE, and this isn't analytical. These are valuation reference lines. You can see that it traded within those ranges of, let's call it 12 to 16 times earnings. But then as earnings began to deteriorate, starting in the 2014 fiscal year, and then they went into losing money in 2017, 18, and 19, and the stock price fell precipitously. You can see that here from peak to trough, and not quite perfectly, but it lost over 74% of its value, which would have been like over this time frame almost a 14.5% annualized loss. But then as earnings began to recover, the market got a nice little pop here. For the 2 years from March 2020 to 2022, we averaged almost a 56% rate of return. But then once earnings flattened again, what we see, and again, it's how earnings are so critical, we see that the stock once again went into losing about 14%. But in this case, it was a combination of dropping earnings, modestly dropping earnings, and a high valuation relative to that. As far as the future is concerned, analysts do expect about 5% growth going forward. That would indicate a 15 multiple. If they traded at the normal multiple the company's been trading at, that would be about a 15.4. That's for the last 5 years. So this could be attractive at these levels here, but I would call it somewhat speculative. You're looking at just making some pretty strong returns by the stock growing modestly, but then your PE ratio expanding dramatically. But you would need that PE ratio expansion to make any money here. So it's an interesting stock to look at. I can see why people did. Its history is kind of scary. Now again, be careful with statistics. If I shorten this time frame here, it looks like it grew at 20%, but that's 141% year. So if I shorten that just by 1 year, now the growth is down to 6.3%. That's why I love FastGraphs so much, is because you can evaluate stocks over different time frames and evaluate how the business has performed relative to how the market is valuing that, and then help make decisions whether a stock is a good buy or not. Anyway, it's been Chuck Carnevale. Thanks for watching. This was an interesting subscriber request on Mattel. Not a stock I'd be very interested in personally, but it's one that people have asked to see, so I showed it to you. If you liked the video, give me a like, ring the bell, subscribe to our YouTube channel, and take a look at subscribing to FastGraphs, the value investor's best friend. Thanks for watching.